Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Todd Rosenbluth, Head of ETF and Mutual Fund Research at CFRA. We're talking about the top ETF stories of the first half and the best investing ideas for the second half. Todd, welcome back on the show.
It's a pleasure to be with you, Nina. Thanks for having me.
So we spoke last, I think, at the beginning of this year. And to say that it's been an interesting first half would be an understatement. It seems that we are in a totally different world now. Now, talking about ETFs, let's start with ETF inflows in the first half. And it was a great 6 months for the ETF industry. US listed ETFs gathered more than $200 billion, and that was significantly more than they did in the first half of 2019. Now, some trends really stood out. We saw record inflows into fixed income ETFs, and that's partly due to Fed's announcement about their purchases of corporate bond ETFs. Then almost $40 billion flowed into gold ETFs, which is not surprising because gold is up almost 20% this year and trading near its highest level in almost 9 years. Then another interesting thing was that Vanguard trounced BlackRock in asset gathering. In fact, Vanguard's ETF attracted about $89 billion, and compared to that, BlackRock took in just about $38 billion, which is a lot. But if you compare that to Vanguard's, it's really small. So, what are your ideas? What are your thoughts on ETF inflows in the first half? And also, what is your forecast for the ETF asset growth in the rest of the year? And which areas do you think will be more popular with investors? Do you think we'll see more inflows into bond ETFs and gold ETFs in the later half of the year too?
So, Nina, let's break that down into a couple of different areas. Fixed income, you mentioned, was extremely popular. It's roughly 20% of the overall ETF pie and saw nearly half of the inflows in the first half of the year. I think demand was strong heading into the Federal Reserve, announcing they were going to be buying bond ETFs, but then that was an additional catalyst. We saw institutional investors really gravitating towards the liquidity and the price discovery that fixed income ETFs offer. And instead of the fears that are out there of investors trying to exit and not being able to do so in a crowded market, they did quite fine. It was actually more mutual fund investors that faced challenges in trying to exit and get clean pricing. So I think fixed income ETFs is really one of the huge stories of 2020, and I think it will continue and could help us to drive record overall ETF flows for 2020. We're on a great pace with $200 billion through the first half of the year. We could certainly see an acceleration. You touched on commodity ETFs, in particular gold ETFs. This is just 3% of the overall ETF pie, and it had 17% of the net inflows. So not only gold-related products like GLD as a safe haven, but energy products, investors bottom fishing with using USO and other energy commodity products was quite common. And I guess the last thing I would touch on from a flows perspective in the equity space is we really saw greater adoption of sector and industry ETFs, about $18 billion of net inflows, products that are from the more strong performing slices of the market, like technology with Vanguard's technology ETF VGT, and healthcare with the Sector Spider XLV, that's a healthcare select Sector Spider. But also we saw utilities and energy products, yin and yang oriented products that were both out of favor from a performance standpoint, quite popular. So I think we've set the stage for a really strong second half of the year, and happy to touch on additional topics about what's ahead.
Yeah, definitely very encouraging. So let's talk about some of the best performing areas of the first half. And we all know that cloud computing, e-commerce, software and services, these are the areas that benefit from the current crisis. So those related ETFs did very well this year. One that surprised me a bit was by ARC Genomics ETF, which is up more than 70% this year. And in fact, that's not the only ARC ETF in the top 10. There are two more. Those two benefited from Tesla's exponential surge because Tesla is a top holding in those ETFs. But kudos to Kathy Wood for excellent performance of her products. So tell us about your thoughts. Did anything surprise you about top performing ETFs? And do you expect those trends to continue?
So technology and healthcare, those are the two, I think, themes that clearly have been strong performing and are connected to the strategies that you touched on. Either the broadly diversified strategies, I touched on VGT and XLV, which is where the flows went to, but the more narrowly constructed products. So you mentioned the genomics fund, traditional, if that's the right word, biotechnology oriented products like IBB and XBI were quite strong performers. You touched on narrower slices of technology like cloud computing. Products like SKYY is a First Trust ETF, WisdomTree's Cloud ETF, another strong performer as well. So the more narrow slices, thematic oriented products, I think certainly showed the value of being tactical and targeted. And actively managed ETFs are no longer an oxymoron, and I think we'll get to that in some of the new product development. But active management can work in an ETF wrapper if you get your stock selections right. As to what's ahead, we at CFRA have not only individual recommendations on ETFs, as well as individual stock recommendations that are often inside these ETFs, but we offer a top-down strategy call, and technology and healthcare are two of the three sectors that we think can outperform in the second half of 2020. So we think that the winners, or in some of these cases, the winners could continue to win at the sector level, although, of course, the ETFs are going to be driven by what's inside.
I agree with you. Technology and healthcare still look very attractive in the current environment. So those areas may continue to outperform other areas of the market. Now, I wanted to talk a little bit about ETF and ETN closes this year too. And we have seen a record number of liquidations. So we know that this trend we have seen this trend over the past few years. ETF providers continue to launch very innovative products because they are struggling to find the next big thing. They also try to capitalize on the hottest themes, and sometimes those themes remain hot and relevant. Sometimes they don't. So what are your thoughts on these closures? Is this good for the industry? And do you expect this trend to continue?
So I think a couple of things have been happening in the first half of the year. One is we're rightly talking about both ETFs and ETNs, exchange traded notes, but a good chunk of these ETNs, or a good chunk of the closures, have taken place within the ETN, the exchange traded note space, either because the products were not functioning and working well, or they actually did what they were supposed to do, but they continued to significantly lose money in a volatility enhanced marketplace, or firms have chosen to no longer offer them. So TVIX, for example, which is $1 billion or was $1.5 billion exchange traded note volatility base, it closed. So it wasn't for lack of usage or interest; it was a lack of motivation by the bank offering it. So I think that's a good chunk of it, and I wouldn't read too much into it other than ETNs have not been popular, TVIX being a rare exception. ETNs are much less popular than traditional ETFs, and the asset manager or banks behind them are less motivated to be a part of it. The ETF closures that have been happening, I think, fall into a couple of buckets. We certainly have seen some themes that didn't make sense. We saw currency hedge products that no longer, or that never actually took off. Those products never took off. The theme has been out of favor for a number of years. But it's just natural for firms that are continually introducing new products into the marketplace to pare something back that has no assets or unlimited volume, and bring something new to market. So we've seen new products coming from some of the larger providers as well as some new entrants to the ETF market. And I think that's just healthy as well. You want to clear out the inventory, make sure that you're not crowding it up with products that aren't going to trade, and take another crack with new development.
Makes a lot of sense. Now, another big story recently was about the proposed labeling system, the new labeling system. We know that some big ETF providers, they have proposed a more narrow definition of exchange traded funds and leverage inverse commodity based ETFs. They will not be called ETFs under this proposed labeling system. They will be called exchange traded instrument or exchange traded commodities. So do you think this proposed labeling system will help investors, or it will add to investor confusion? And you know that we try to educate investors about the difference between ETFs and ETNs, as you mentioned earlier. And but I don't think many investors understand the difference between even the current ETFs and ETNs. TVIX is a great example. I am not sure if many investors who were putting money in that 1.5 billion or whatever that ETN was, whether they understood that this is not an ETF, it's a note.
So, short answer is I don't think it solves the problem, because I'm not sure that the problem is solvable. Investors know tickers. Either they don't know what they're available, or they know tickers. So USO, which is the United States Oil Fund, is perhaps the latest example of an exchange traded product that investors had challenges being able to do. And this is a product that is futures based under the proposed classification system from within the industry. It would likely be considered an exchange traded commodity as opposed to an exchange traded fund, an ETC. I'm not sure that if you change the name of it to United States Oil Commodity, that would actually have changed investor demand. I think people see oil in the name and they know of the ticker, and they're going to think that it's a liquid way of getting exposure to direct exposure to oil, whether or not it has the word fund or it has the word commodity within its name. So I think we as an industry are trying to solve the problem of getting more folks into the tent and see the merits of the traditional exchange traded fund wrapper, which will continue to expand the pie. But we're using terms like smart beta, we're using terms like semi-transparent ETFs or non-transparent ETFs that I think we're going to get to in a minute. And that's confusing already. I don't know that breaking up what is an ETF into an exchange traded commodity, an exchange traded instrument, and an exchange traded fund actually solves that problem.
Yeah, that makes a lot of sense. And you mentioned USO, which is so popular on Robinhood with these newbie investors, day traders. And I don't think changing the name would deter them from putting money into that ETF if they believe that oil will continue to rebound. So late last year and earlier this year, there was a lot of buzz about the new non-transparent actively managed ETF structure, or ANTs. And in fact, the first of these ANTs launched by American Century, they started trading in April, and then we saw some products by Legg Mason and Fidelity, and some more issuers, including some big ones, may launch these products in the coming months. They haven't seen a lot of investor interest. So what do you think of this structure as such, the non-transparent ETF structure? And do you think they'll be able to gather assets this year?
So I'm excited that these products have come to market. I'm excited that we have some prominent firms. You mentioned American Century and Fidelity and ClearBridge, which is part of the Legg Mason brand, are out. T. Rowe Price has been approved and will likely come to market in July or perhaps August. And we have other firms that have signed on to do this: Invesco, JP Morgan, iShares. So the industry is starting to come in launching products. The demand has not been there, in part because in some of the cases we aren't public. The industry is not known what is inside these. So I think even though it's delayed transparency or semi-transparency, investors will want to know what it is that they're getting, even if that may be changing. And they need to be able to have a chance to see how these products will not only trade, if they'll trade in line and with volume, but also are they going to perform well. Some of these are going to outperform, some of these are going to underperform, some of these are going to gather assets, others are not. I still think that there's going to be demand for this. It may not be as quick as I'd originally hoped. My hope and expectation was that asset managers would have come to market with lined up interest, and they would have had a chance to educate internally and to start that process, talking to partners once they got approved. That has not happened, but I'm still confident that there's an audience for this. As we talked about earlier, you can outperform with active management. The ARC funds has demonstrated that you can also underperform with active management too. Lastly, if I may, I don't think investors are going to care as much that there's a delay. That the fact that we know how much Tesla the ARC funds holds, I'm not sure as important as we know that this is a stock that they hold and that they continue to have confidence in. And so whether the holdings are as of yesterday or they're as of a month ago, I'm not sure the average investor is going to care. If the performance is good and the strategy makes sense to them, I think they're going to be happy to get in a more tax efficient vehicle. But we'll see.
That would be very interesting to watch this year. Now, going back to ETF launches, we have seen more than 120 new product launches this year, and including some very interesting ones in the last few weeks, particularly those capitalizing on the virus theme. This one by ETF MG Group. It is called ETF MG Treatment Testing and Advancement ETF, ticker symbol GERM. And then there's one by Pacer. It's called Pacer BioThreat ETF, ticker symbol virus. There's one by Direction, the Direction Work from Home ETF with the ticker symbol WFH. Very interesting. And there's a new sports betting ETF, ticker symbol BETS. These are some of the interesting ones which come to my mind. So tell us about your thoughts on these ETFs and also your favorite new ETF this year.
So I don't have a favorite new ETF. Just for perspective, we at CFRA rate ETFs, as I think so do you, and we have commentary on them. Our rating methodology looks in part at the underlying holdings, the costs, and the performance record. So we are rating some of the ETFs that have launched in 2020, but a number of them, and in some cases, they're products that you touched on that are interesting, but we don't yet have a rating on. So if I can, I'll twist your question to something I can more objectively answer now in terms of ticker, my favorite new ETF ticker. So I think two of them are you touched on some of them that I think are quite compelling. One that I would put up there of the sports betting ETF, BETZ Bets, which is a Round Hill product. It's the only one that's like it. Obviously, sports are not happening right now as you and I are talking in early July, but they're coming. But I think this certainly fits into a retail-oriented theme. Sports betting is quite popular, and I think is a long-term trend that makes sense. Whether it's a good investment trend is different than a trend that makes sense. And I think the ticker tells you exactly what it is. The other ETF is Direction's Work from Home ETF. The ticker is WFH. This ETF combines a few themes, including document management and cloud computing and communications companies like Zoom, which we're now increasingly using to get through our workday. I think this is a theme that makes sense, but it's also the ticker. I think everyone knows what WFH stands for. And so I think that it's going to stick with investors if they want to go this investment route.
Those two are definitely very interesting ETFs and very interesting ticker symbols too. Now, let's talk about the second half of 2020. What are your best investment ideas for the second half of 2020? And can you give some of your top ETF picks too for our listeners?
Sure. So let me touch on a couple of themes. We think that there is going to be a reversion to the mean that's possible. And so some of the international markets that have underperformed the US are likely to do well, Canada being one of them. And so we were highlighting this month the JP Morgan Beta Builders Canada ETF, BBCA. This is a low-cost way of getting market cap weighted exposure to Canada. Canada has underperformed, but it's well constructed, this ETF. It's relatively cheap. And so I think this is something that's compelling to take a look at in the US. We do think that it's going to be bumpy, but still a recovery for the earnings picture certainly in the second half of the year. As possibility into 2021. And so blue chip quality companies are likely to do well. We like QUAL, which is the iShares MSCI US Quality ETF. And then at the risk of sticking again with the same firm, but I will, iShares Investment Grade Corporate Bond ETF, LQD, which has been extremely popular. It's also being bought by the Fed, but it's being bought in general by investors. We think the investment grade corporate bond market is highly liquid. We think this is a good way of getting exposure to it in a cheap way. And the risk reward of investment grade corporate bonds is relatively appealing to us. So those are three ETFs that we at CFRA have 5-star ratings on, but we cover 1,800 ETFs. So I could name, certainly a couple hundred more products that we're recommending for our clients today.
Very interesting investment ideas, and international markets, including Canada, definitely look very attractive from valuation perspective. And in fact, Canada has done quite well in containing the virus too. So that's additional point in favor of Canada ETF. And you mentioned
a good point, yes.
And quality companies generally do very well in the low growth environment, which is likely to continue for some time. So definitely a very appealing pick there. So that's all we have time for today. Todd, thank you again for joining us.
My pleasure. Thanks for having me.
Thanks for listening. You can follow Todd on Twitter @ToddCFRA. Make sure to be on the lookout for the next edition of ETF Spotlight, and also make sure to subscribe. If you have any comments or questions, please email podcast@sachs.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.